Climbing the wall of worry. After a robust upswing for stocks in the first quarter, the second quarter gave back much of those gains. Temporary defensive portfolio tactics helped you avoid much of the decline the past 3 months. Mounting levels of global uncertainty once again weighed on investors. The ongoing European financial crisis, Asian economic growth slowdown, political year uncertainties, an oncoming year-end fiscal cliff, sagging consumer confidence, and a weakening U.S. economy all added to investor insecurities and pressured stock prices. Question is, does the news get worse, or has the market overreacted, and contrarily, is it now positioned to climb the proverbial wall of worry? Our view is the stock market is poised to move higher and enjoy a stronger second half of the year. While acknowledging the array of issues weighing down investor expectations, there are also some veiled or unrecognized positives not factored into the marketplace. When we balance the facts, we conclude the stock market has more upside potential than downside risk. Let's review the known concerns and also express some potentially positive outcomes. The Great Wall of Worry. The European financial crisis. Eurozone leaders recently held their 17th, or is it 18th, summit meeting to deal with their badly damaged banking system and sovereign debt problems. This extended, messy attempt to deal with budget deficits, bank capital deficiencies, rising government debt burdens, and the habitual overspending has tortured investors off and on for the past 2 years. During that time, political and monetary leaders struggled to come up with a meaningful way to acknowledge large losses at the major European banks. The massive losses stem mostly from investments in now questionable sovereign debt issues, namely government bonds from the PIGS countries, Portugal, Italy, Ireland, Greece, and Spain. Recent agreement on a plan to bolster the banks with fresh capital from Eurozone governments to improve bank balance sheets and write off the bad debt mirrors actions the U.S. took to stabilize our banking system in 2008-2009. Markets reacted very favorably, once again, to this positive step towards stabilizing the badly wounded European banking system. This is one worry being shuffled to the back burner, at least for the time being. The looming fiscal cliff. The term fiscal cliff refers to the combination of significant tax increases, medical cost hikes, and mandated federal budget spending cuts scheduled to take effect at year-end 2012. Economists fear the result will be sharply lower economic growth, which raises the probability of a new recession. The looming fiscal cliff is another legitimate concern facing investors today, but we would argue much of its effect is already substantially priced into the markets. Our expectation is congressional leaders will not want to go through another politically damaging financial stalemate like last summer. Look for some action before year-end to head off the fiscal cliff issue and relieve investor fears. Any progress diffusing the fiscal cliff time bomb may very well be a messy political circus, but could remove another layer of uncertainty and lead to higher stock prices. The most significant consequence of the Great Recession and subsequent anemic economic recovery is the U.S. consumer is left with a particularly jaundiced view of the world. One important measure, the University of Michigan Consumer Sentiment Index, is sagging relatively close to a 50-year low, part to the above-mentioned economic and other current geopolitical worries. Consumers have a bleak outlook for their economic well-being, but we would argue, counterintuitively, that this can be a positive for stocks. Historical studies demonstrate low confidence readings are actually a long-term positive for future stock market returns. Our table illustrates low confidence tracks favorably for future investment profits. There's an old Wall Street saying that the best returns come when the stock market climbs a wall of worry. And what could possibly go right? Amidst all the worries, what are some potentially positive surprises? Energy prices could continue to moderate, putting more spending money in consumer pockets, reducing corporate operating costs, and boosting economic growth. Another would be U.S. economic data such as auto sales, business loans, and employment continue to show their modest improvement. New home construction and sales, spurred on by record low interest rates, are meaningfully starting to contribute to growth. Another possibility, emerging market countries, China, India, Latin America, could take stronger actions to stimulate economic growth in their own countries, thereby spearheading renewed global growth. Finally, stabilized and improving home values in the United States could add to the positive wealth effect for households for the first time in 5 years. This is the most unexpected and welcomed economic surprise. Bottom line, the best investment opportunities for investors happen when confusion and worry are the greatest. Investors can have either worries and low stock prices, or good news and high stock prices, but not good news and low stock prices. We believe today is an opportunity for patient and conservative investors. So much negative news is already factored into today's stock market that anything less bad will result in a continued dynamic up move. Shifting our tactics to offense. Last quarter's newsletter expressed our expectation for stocks to consolidate the first quarter's advance and pull back in price during the second quarter. Weakness did indeed take place, and concurrently, more quality values surfaced. We are now shifting tactics due to our more positive view. The game plan is to methodically add attractive growth and income investments into your portfolio. Our goal is to position your portfolio to take advantage of the anticipated up move. Pring Turner holds high expectations to see your wealth reach new benchmark levels in the second half of 2012 as the stock market climbs this wall of worry. Special delivery. Be on the lookout for a package to arrive in the mail for your summer reading enjoyment. Our newly released book, Investing in the Second Lost Decade, will be mailed out to clients before month end. The book details our long-term market outlook and the survival tactics necessary to successfully navigate another lost decade. We are especially pleased to have the book reviewed in the New York Times business section. The investment philosophy, methodology, and decision-making process described are the same that have brought you successfully and profitably through the last lost decade. We appreciate your loyalty, and we look forward to do even better for you in the next decade. Thank you.